Right, let's kick this off with the number everyone thinks they understand, but barely anyone actually does. Inheritance tax. HMRC's favourite way of saying congrats on building something, now hand us a chunk of it. Here's the headline. The nil-rate band, the tax-free chunk of your estate, is still 325 grand. And before you say, oh, that's not too bad, let me stop you right there. That 325 grand has been frozen since 2009, back when we were all arguing about BlackBerry and iPhone, when Netflix was still posting DVDs through your letterbox. Meanwhile, property prices have moonwalked into the stratosphere, inflation has eaten the value of money alive, and HMRC just sat there smiling, acting like 325k still buys you a 3-bed semi and a golden bloody retriever. Spoiler alert, it doesn't. And because it's frozen until 2028, more estates get dragged into inheritance tax every single year. Not because people got richer, but because the government didn't move the goalposts. Classic fiscal drag. Sneaky, quiet, effective. Honestly, respect the hustle. But here's the important part. Everything above that 325 grand, HMRC takes 40%. No discount codes, no Black Friday sale, just 40% straight off the top. So if your estate is even slightly above average, house, savings, a small business, you're already in IHT territory whether you realise it or not. And that's why people like me talk about planning, because if you don't, HMRC will happily take more from your estate than some people earn in a year. And that's just the warm-up. Next we'll get into the part everybody forgets, the home allowance, the Residence Nil-Rate Band, where the real tax savings live, and where most people accidentally lose thousands. Let's get into the part HMRC almost whispers about. The Residence Nil-Rate Band. The extra allowance you unlock only if you play by their rules. This one's worth 175 grand. That's on top of your standard 325 grand. So suddenly, one person can pass on $500,000 tax-free. Sounds dreamy. Well, brace yourself. This is HMRC we're talking about. Of course there's conditions. Of course it's complicated. Of course it feels like it was designed by someone who hates admin but loves paperwork. Here's the rulebook in plain English. If you leave your main residence to a direct descendant, that means children, stepchildren, adopted kids, foster kids or grandchildren, you get the extra 170k allowance. Leave it to your mate Dave, no allowance. Leave it to your cousin because he once fed your cat, no allowance. Leave it to your dog, cute, still no allowance. HMRC is very literal about what family means here, but if you tick the box, boom, 175 grand extra. And if you're in a couple, you can stack these allowances like Lego bricks. 2 lots of 325 and 2 lots of 175. 1 million tax-free. This is why you constantly hear people saying couples can pass on $1 million without paying IHT. It's not magic, it's this allowance doing the heavy lifting. But, and there's always a but, there's a huge trap people fall into. If your estate is worth 2 million, HMRC starts tapering this allowance away. For every £2 you're above that 2 million threshold, you lose £1 of the residence allowance. Big house, a few rental properties, business in your own name, you can lose the whole 175k without even trying. So if you're sitting on assets over 2 million and you haven't done any planning, HMRC is literally licking its lips. And the saddest part, most people don't know any of this. They spend their whole life building a legacy only for their kids to open a brown HMRC envelope and find a bill the size of a small Tesla. But we're not going to let that happen on this channel. We talk about how the tax actually hits and why some estates pay 40% and others pay 0%. The actual tax, 40%, 36%, and the fine print, they don't tell you. We've talked allowances, we've talked HMRC's favourite little loopholes and booby traps. Now let's talk the actual tax bill, because this is the part that knocks the wind out of people. Here's the headline. Once you've used up all of your allowances, the 325, the 175, if you qualify, every pound above that gets hit at 40%. That's not a typo, it's the kind of number that makes even accountants wince. Let me spell it out, how brutal that is. If you die with an estate worth 800 grand and no residence allowance applies, HMRC will happily take 190 grand for doing absolutely nothing, for simply existing at the time you didn't. But, and thank God there's a but, there is a way to cut that 40% down if you leave at least 10% of your net estate to a registered charity. The tax rate on the rest drops to 36%. I know it's not massive, but it's something, and the wealthy use it. Well, they use it religiously. It's the closest HMRC will ever get to giving you a loyalty discount. Thank you for donating. Here's 4% off your death bill. Cheers. But don't get it twisted, this isn't a hack, it's maths. Sometimes leaving 10% to a charity means your kids actually inherit more because the reduced rate applies to the whole taxable estate. It's weird, it's counterintuitive, and it's peak HMRC chaos. Another thing no one says out loud, spouses get a free pass. If you're married or in a civil partnership, you can leave everything to each other with zero inheritance tax. HMRC doesn't touch a penny. Why? Because they're not dumb. They want to collect tax once, and they know the surviving spouse will eventually die. Morbid, but efficient. After that, it's your children or beneficiaries who get the 40% bill. And that's why estate planning is not for rich people, it's for anyone who doesn't want their kids to get an HMRC bill that starts with a 1 and ends with 5 zeros. Next we get into the 2 million estate trap and why so many families unknowingly lose 175 grand. This is the silent killer of inheritance tax planning. So if the last section stung a bit, this one's going to feel like lemon juice in a paper cup. Because here's the truth nobody tells you until it's too late. If your estate is worth more than 2 million, HMRC starts taking your 175 grand home allowance away, pound by pound, quietly, ruthlessly. This is the infamous RNRB taper, and honestly, it's one of the most savage gotcha clauses in the UK tax law. Let me break it down without the jargon. You know that lovely extra allowance that lets you pass on 175k tax-free if you leave your home to your kids? Yep. HMRC starts deleting it once your estate crosses 2 million. For every £2 your estate is above 2 million, you lose £1 of that allowance. Cross the threshold slightly, lose a chunk. Cross it by too much, lose the entire 175k, and then suddenly your kids are paying 40% on an extra 175k just because you didn't know this rule existed. That's a 70 grand tax bill for being too successful. No reward, no congratulations, just HMRC saying, lovely house you got there, we'll take our cut. And here is the kicker. You don't need to be a millionaire in a mansion to trigger this. Between property values, pensions, business shares and savings hitting 2 million is not rare anymore, especially for business owners, landlords or anyone with a decent portfolio. Most people have no idea they're even in the danger zone. But the smart ones, they do planning, they restructure, they gift assets early, they use trusts, they use companies, they use lifetime allowances. They make moves because the alternative is willingly handing HMRC 70 grand just for the fun of it. And before the comments start, no, this isn't tax dodging. It's literally how the law is written. It's reducing tax exposure. That's what accountants do. The wealthy didn't write the rules, they just actually read them. If you don't want HMRC writing the ending to your estate plan, book a call with my team below. They'll run the initial assessment and confirm whether you qualify for our planning process. And if you do, the next conversation will be with me. We only take on clients where we can deliver real impact. Nothing else makes sense. Right, so we've covered the allowances, the traps, the taper, the cold 40% reality. Now let's talk about the one tool HMRC tries not to shout about. Lifetime gifting, the 7-year rule, the OG inheritance tax strategy for your nan, probably used without even realising. Here's how it works. Plain, simple, savage. If you give something away, money, a house, shares, whatever, and you survive 7 years, that gift drops completely out of your estate. Clean, clear, gone. HMRC can't touch it. This is the moment wealthy families start smiling politely, because while everyone else waits until they die to pass things on, the wealthy move assets years in advance. At the kitchen table, in board meetings, inside company structures, or via trusts their solicitor definitely didn't draft on a Tuesday at 4 p.m. 7 years, that's the magic number. Now, if you die within 7 years, it's messy. HMRC calculates taper relief, which is a fancy way of saying you might still get taxed, but maybe a bit less. But let me be very clear, taper relief doesn't reduce the size of the gift. It only reduces the tax on it. People get this wrong all the time. Survive 7 years, gift is free. Die within 3 years, full 40% applies. Die between year 3 and 7, the rate gradually drops. It's literally a timer, a countdown, like HMRC is sitting there with a stopwatch and a clipboard. And this is where the wealthy get ahead. They don't wait until they're old. They gift early, they structure early, they move assets into companies, trusts and children's names long before HMRC's eyes even open. Because here's the uncomfortable truth. Most people die with their wealth. Wealthy people die after giving theirs away. And that is why the tax bill looks different. One more thing, there are exemptions too. $3,000 per year, that's always tax-free. Wedding gift allowances, small gifts, and the absolute gem, gifts out of surplus income, meaning if you can prove it didn't affect your lifestyle, you can give away chunks with zero tax consequences. So yes, the playbook is real, it's legal, it works, and the sooner people understand it, the less they donate to HMRC by accident. This part is what brings this whole story home, how ordinary families end up paying more IHT than the ultra wealthy and what to do about it. Let's land this plane, because everything I've told you so far leads to this one brutal truth. Ordinary families pay more inheritance tax than the ultra wealthy. And it's not because HMRC gives them special treatment, like some of the commenters think. It's because the wealthy plan and regular families simply don't know. Most people in the UK do this. They work hard, they save, they buy a house, they build some equity, they pay the mortgage for 20, 30, 40 years, and then they die with everything still in their name. And HMRC sees that like a neon sign that says, take 40%. Meanwhile, the wealthy have already moved half their assets into holding companies, FICs, trusts, gifts or corporate structures before they even hit retirement. Whereas the average family dies owning everything, the wealthy die owning almost nothing because the assets have already been moved to the next generation, years or even decades earlier. And here's the part everyone hates hearing. Inheritance tax isn't a tax on the rich, it's a tax on the unprepared. A 700k estate with zero planning can pay more IHT than a 10 million estate that's been structured properly. And it happens every single day. Ordinary families get caught by the frozen 325k threshold, the 175k home allowance rules, the 2 million taper, poorly written wills, houses held personally instead of corporately, no gifting strategy, no trusts, no corporate structuring, and zero visibility on how the system actually works. Meanwhile, the wealthy treat tax like a business process, not an emotional one. They plan, they organise, they follow the rules better than anyone, and HMRC takes exactly what the law says it can take, which for them is usually very little. And honestly, it doesn't have to be like that, not for normal families, not for business owners, not for anyone who takes the time to understand this stuff. The system is complicated, but it's beatable. If you play the game early, and if you don't, HMRC will write your ending for you. I'll show you the simplest, cleanest steps to protect your estate legally and stop HMRC taking money your family shouldn't have to lose. Right, let's wrap this up with the part that actually matters. What you can do about all of this, because I'm not here to scare you with tax facts, I'm here to give you tools. So here are the simplest, highest impact moves to legally reduce your IHT bill without doing anything shady, stressful or stupid. Number 1 is get a will, a proper one, not a 20 quid template. I know it's boring, but if you die without a proper will, HMRC basically gets to rearrange your assets like a toddler with Lego. A professionally drafted will is the foundation of every good IHT plan. Use the 325 and the 175k allowances properly. Make sure your home is passed to a direct descendant if you want that extra 175 grand relief. If not, you lose it. It's as simple as that. Watch the £2 million estate taper like a hawk. If your estate is anywhere near that line, You must do planning, because losing the 175k is a 70 grand tax mistake. Use lifetime gifting while you can. The 7-year rule is powerful. Think ahead, move assets early, give with intention, not panic. The wealthy don't wait. You shouldn't either. Consider holding companies, trusts, or a family investment company. These aren't rich people toys. They're everyday tools the wealthy use to control the assets without personally owning them, which is why they avoid IHT legally. If you own a property, a business, or a portfolio, this matters. Review it every year. Life changes, so should your tax plan. New house, new business, new partner, new baby, new assets. Whatever life throws at you, your estate plan needs to keep up. Inheritance tax isn't emotional, it's procedural, it's mathematical, and it's beatable. The people who lose thousands are the ones who do nothing and hope. But the people who win, they take control early. They learn the rules. They build structures that protect their kids, their home, and the legacy they have grafted for. You can do this. Your family deserves this. And HMRC has taken enough from you already. If you want help setting this up properly, structuring, gifting strategy, holding companies, family investment companies, whatever fits your situation, you can book a call with me using the link in the description below. And if you want a simple, actionable breakdown of how to plan your taxes for the year ahead, my tax game plan, which is also linked before, lays out the basics. That is the foundation of your tax planning. And of course, please subscribe if you want the kind of tax knowledge that actually saves you money, not the generic stuff HMRC puts on a 44-page PDF. I'm Sarah from Tax for Pros, helping businesses build wealth, not just businesses.